All right, welcome to The Explainer. Have you ever really stopped to wonder what makes a law work, or how we could possibly predict the ripples it'll send out into the real world? Well, today, we're going to build a brand new toolkit using the fundamental ideas of economics to finally make sense of the legal world.
It all really boils down to this one question, doesn't it? How do we know if a law is good or bad? Is it just a gut feeling, or is there a more systematic, a more rigorous way to figure it out? Well, that's exactly the framework we're here to build today. So here's our roadmap. First, we'll nail down what good even means in this context. Then, we'll introduce the one core assumption that holds it all together: rational choice. After that, we'll add three powerful pillars for our analysis, look at what happens when ideal markets break down, toss in the wild card of risk, and then finally, put it all together to see how it works in the real world. Okay, first up, what's the mission here? We're diving into the field of law and economics to take that huge, kind of fuzzy question and turn it into something we can actually get our hands on, something we can analyze and answer.
You know, when you strip it all away, it comes down to a really powerful two-step process. First, we predict. We ask, okay, how is this law actually going to change the way people behave? And then, second, we evaluate. Are those changes, those new behaviors, actually good for society as a whole? That's it. Answering those two questions, that's the entire game.
Now, if we want to predict anything about behavior, we have to start with a basic theory of how people make decisions. And this, right here, is the single most important building block in our entire guide: the concept of the rational actor. Okay, now hold on. When an economist says rational, it does not mean people are perfect, emotionless robots. Not at all. It's a much simpler and I think much more realistic idea. It just means that given the choices you have and the constraints you're under, like your budget or how much time you have, you'll pick the option that you believe is best for you. And that simple, predictable desire to do what's best for ourselves is what makes behavior analyzable. So, with that foundation of rational choice in place, we can now bring in our three main pillars of analysis. These are the heavy-duty tools we'll use to really understand what's going on: maximization, equilibrium, and efficiency. Our first pillar is maximization. Think of it this way: if rational choice is the car, maximization is the gas pedal. It gives us the motive, the direction. We assume that you, as a consumer, are trying to maximize your happiness, or as economists call it, utility. A company, it's trying to maximize profit. A politician, they're trying to maximize votes. By assuming everyone is trying to get more of something, we can start predicting how they'll act.
So what happens when you have millions of these maximizing individuals all interacting with each other? Well, you get our second pillar, equilibrium. It's a state of balance. It's the point where everybody has made their best move based on what everyone else is doing, and nobody has a reason to change what they're doing. It's where the system comes to a rest. And that stable outcome, that's the thing we can actually study.
And this brings us to our third and final pillar: efficiency. This is the yardstick we use to judge whether that equilibrium we found is good or bad. Now, this is absolutely crucial. For an economist, efficiency is not about fairness or equality. It's a very specific, cold, hard measure. Are we wringing every last drop of value out of the scarce resources we have? And efficiency really comes in two main flavors. Productive efficiency is pretty straightforward. Are we making stuff without being wasteful? You know, using the fewest possible resources to get the job done. But the really mind-bending idea, the one that's so powerful for law, is allocative efficiency, often called Pareto efficiency. It asks this profound question: is there any way to make even one single person better off without making anyone else worse off? If the answer is no, if any change we make would hurt someone, then we've hit what's called a Pareto efficient outcome. We've squeezed out all the free improvements.
All right, we have our toolkit, maximizing people, equilibrium, and our yardstick of efficiency. That's our perfect, clean model. But the real world is messy. So now let's look at what happens when that beautiful system breaks down, a concept economists call market failure.
See, in a textbook, a perfectly competitive market is basically magic. It automatically, without any help, leads to a Pareto efficient outcome. There is no waste. Everyone who wants to buy at the going price can. Everyone who wants to sell can. It is the absolute gold standard of efficiency.
But, of course, we don't live in a textbook. In the real world, markets fail all the time. They get stuck, and they don't reach that perfectly efficient point on their own. And this, right here, is the justification for so much of our legal system. It's why the law has to step in.
There are four classic ways markets get it wrong. First, you've got monopolies, where one seller calls all the shots. Then there are externalities. Think of pollution, where a factory gets the profits, but society gets the dirty air. Third, public goods, like clean air or national defense, things that are hard to charge for, so nobody wants to provide them. And finally, information asymmetry, a fancy term for when one person in a deal knows a lot more than the other. Honestly, correcting these four failures is one of the main jobs of the law.
Okay, there's one last crucial layer we need to add to our model. So far, we've kind of been pretending the future is predictable. It's not. It's uncertain. So how do rational people make choices when they're staring risk right in the face? Well, the first, most logical step is to just calculate the odds. You figure out the expected monetary value. You just take the chance of each thing happening, multiply it by the cash payoff for that thing, and add it all together. It's simple, straightforward math. But, and this is a huge but, here's the twist. People don't just maximize the average expected cash, they maximize how they feel about the outcomes. For most of us, a 100% chance of getting $100 feels way better than a 50% chance of getting $200, even though the expected monetary value is exactly the same. We maximize our expected happiness, our utility, not just our expected bank account. And this difference in how we feel about risk sorts us into three basic camps. Most of us, as you can see, are risk-averse. We prefer the sure thing. We'll take the guaranteed $100 over the risky shot at $200. A computer might be risk-neutral. It just sees the numbers. But very few humans are. And then you have the risk seekers, the gamblers who actually love the thrill of the bet. Knowing which group you're dealing with is key to predicting behavior. And our dislike of risk isn't just a psychological quirk. It creates entire markets. It's why we buy insurance, to trade a small, certain loss for protection against a huge, uncertain one. It's why we self-insure, by installing smoke detectors or wearing a seatbelt. And it's why in finance, we demand to be paid more, a risk premium, to hold a risky stock. Huge industries exist just to help us manage our fundamental dislike of uncertainty. So, let's pull all these threads together. We've got our rational actors, all maximizing their own utility. They're interacting in markets that can sometimes fail. They're all dealing with risk. How does this whole framework actually apply to the law in the real world? Okay, here it is, the bottom line. The most important takeaway is this. Law is not just about punishment. It is one of the most powerful economic tools we have. Contract law lets us trust strangers. Property law gives us the confidence to build and invest for the future. Tort law makes sure that people have to pay for the external costs they create. By creating a stable, predictable rulebook, the law builds the foundation of trust and cooperation that an economy absolutely needs to function and grow. I want to leave you with this fantastic little quote. It's a puzzle that perfectly captures one of the deepest problems in economics. How do you finance a good idea? The bank says, I'm not going to pay you $1 million unless I know the idea is good. But the innovator says, I'm not going to tell you my $1 million idea until you pay me. It's a perfect standoff. It's a market failure caused by information asymmetry and a lack of trust. And what's the solution? The law. Things like patents, non-disclosure agreements, complex venture capital contracts. These aren't just legal mumbo-jumbo. They are the sophisticated bridges we build to solve these exact kinds of economic problems, proving just how deeply our prosperity is tied to the design of our laws.